Good morning. I would like to extend a warm welcome to you all and thank you for having joined this webinar, which forms part of the MFSA's efforts to engage with the industry in relation to the revised Capital Requirements Directive and Regulation package, which forms part of the CRR2. In this seminar, we'll outline the changes for banking institutions regarding the Basel III. The objective of the supervisory reporting is to fully reflect all the new and changed regulatory package and data requirements, which to adapt to the adjustment in the regulatory package. Before getting you a quick preview of today's program, I would like to highlight a few points. First of all, the MFSA takes security very seriously, and this webinar is being conducted using Microsoft Teams, which follows all the security and protocol in view of the COVID-19. Secondly, please note that this webinar is being recorded and will be updated in the MFSA webpage. Thirdly, certificates of attendance are only generated if you have logged in to the webinar using your email address and details. As you can appreciate, no certificates can be issued if you have not logged in anonymously. If you have not currently logged in with your credentials because you have not accessed the Microsoft account yet and will have to remove a certificate of attendance, you can access this document which is available on the events page of this MFSA webpage. Kindly submit your questions in the Q&A session of this webinar, which can be found on the top right corner of the screen prior to Q&A session. Now, on to this morning's webinar. We will start this webinar with a welcome remarks delivered by Mr. Victor Patch, Deputy Head of Banking Supervision, which is followed by a detailed presentation by Ms. Roberta Darmanin, Senior Manager, Banking Supervision, regarding the CRR2 reporting framework. We'll then move on to a coffee break, scheduled at 11:15, and finally, we'll resume at 11:30 for the Q&A session. Now, I pass on the microphone to Mr. Victor Patch, Deputy Head, Banking Supervision. Thank you.
Good morning, everyone, and welcome. I hope that everyone present today is okay and looking forward for this session. I'm also proud to say that today we have a very good number of attendees, and our aim is to provide an informative and interesting session to you. By way of introduction, my name is Victor Patch, and I am one of the 4 deputy heads within Banking Supervision. I am currently heading the authorization and data teams. I am relatively new to the authority, and I joined the authority in April of last year. Obviously, it was 1st of April, which is most of the time associated with April Fool. But I can assure you that this has been already an interesting and pleasant journey for me. The time when I joined the authority, we had already started working virtually, and I believe that today I have met more people from the audience than possibly from the MFSA teams. Well, as you are aware, the authority embarked on a number of events and webinars, and the purpose of today is to focus on the regulatory requirements in relation to CRR2. The scope of these meetings are to create a channel of dialogue with the industry and any queries and uncertainties can be discussed and probably clarified during this fora. Now I will pass on the floor to my colleague, Ms. Roberta Darmanin, who I believe most of you already know. Thank you very much and enjoy our session. Thank you.
Thank you very much, Victor, for this introduction. So we will now be starting delving into the requirements on CRR2, specifically in relation to reporting. First of all, however, I would like to introduce myself, or maybe for those who have not are not acquainted with me. My name is Roberta Darmanin. I've been leading the data team for the past 3 years, and I've been employed at the MFSA for the past 10 years, and I'm looking forward for more. So, okay, we can start with the presentation. We will wait. Okay, thank you very much. So we will start with CRR2 Supervisory Reporting Framework, in which this presentation we will be outlining main developments that CRR2 will bring about in supervisory reporting. As a brief overview of what we will be going through, we will first provide a background with some business and also technical developments that came about with as from this year. We will then move on to outline several details with respect to reporting modules that came and changes that came about with CRR2 specifically. And at the end, we will also go through some notes which we deem are very useful for the industry. We will start with the background. A very nice picture there of Valletta. Better to be there, but we're here today. So we'll start with the reporting regulation. So essentially, the EBA has decided to implement a new regulation for reporting, just a regulation 2021-451, which actually repeals the so-called old regulation, that's 680-2114. The reason for this change and this update was because there were so many significant changes that it was deemed better and very relevant to have the new requirements outlined in a new reporting regulation. The ITS regulation outlines reporting requirements in accordance with CRR2. There are specific articles which mandate the reporting requirements. The application date of the new ITS, which is ITS version 3.0, it's being called, is 28 June 2021, which makes the first reporting reference date of 30 June 2021. A good point to note here is that the reporting regulation consists of 3 main areas. That's the regulation text and also includes annexes with the data templates and also the reporting instructions. At this point, it is very important to note that the reporting instructions are part and parcel of the entire regulation. So adhering to those instructions is a very essential part of the entire framework. Okay, some general details with respect to the regulation and CRR2 in general as well. There are unchanged reference and remittance dates, so there are no changes with respect to deadlines. CRR2 has brought about 2 new concepts with respect to classification for institutions. The first one is the small and non-complex institution classification, and the second one being the large institution classification. You may recall that in mid-2020, we have the MFSA has sent a letter in writing to all the credit institutions in Malta outlining the SNCI status for each and every credit institution. It is worth noting as well that institutions not falling under any of the above classifications, so not being small and non-complex and neither large, may be referred to and is being referred to by both EBA and ECB as regular institutions. ITS Article 4 of the reporting regulation outlines some reporting thresholds and entry and exit criteria. Additional entry and exit criteria have also been included as part, including the concept as well of the SNCI and large institution classification. So it's a very good, it's very important that institutions are aware and go look into specifically into this article of the reporting regulation. One last thing with respect to the regulation itself is that it is now promoting the use of the legal entity identifier as identification of counterparties. As an example, most of you are aware that the large exposures reporting requires the counterparty by counterparty details. And essentially what the regulation is now doing is essentially making it mandatory to use the LEI as the code of those counterparties where that LEI, of course, is available. We will move on now to some technical developments that are brought about with ITS version 3.0. So the first technical development is the move to 4-digit row and column numbers in data templates. So essentially, you may have already noticed that the row and column numbers are now moved from 3 to 4 digits in some of the respective reporting modules. Some others, however, large exposures, asset encumbrance, and ALMM are still unchanged. However, the EBA does plan to change these as well in upcoming reporting releases, so it's good to keep an eye on those as well. Another technical development which is very important and very essential is with respect to the EBA validation rules. The first point is a move to 5-digit IDs for all the validation rules. So this was previously 4 and now it's 5. The second and more important point here is the improved management of validation rules, whereby EBA has started this year publishing 2 types of validation rules packages. The first one is the small validation rule package, and this includes reactivations of rules, deactivations, and also severity status changes from warning to error or the other way around. The frequency of publication by the EBA is on a quarterly basis, and it essentially, the small validation rule package essentially is applicable as from the date of publication by the EBA. In practice, it applies uniformly to subsequent submissions and resubmissions of the framework that is currently in use on the date of the publication, including also the resubmission of past reference dates. The second type of package that is published by the EBA is called the updated VR package. And it essentially includes anything that is included in the small VR package with the addition of new rules and also amended rules. This updated VR package is published around 2 months before the first applicable reference date, and it applies upon the next framework that is the first reference date of the upcoming framework of the reporting. We will now move on to provide a very brief overview at first before going on to more details. So as you can see here, this table lists all the reporting modules that come about with ITS version 3.0. There's a split between existing and new reporting modules. So from the existing modules, there have been significant changes experienced in 4 specific modules, that's own funds, leverage ratio, NSFR, and also FINREP. There have been minor or no changes at all in large exposures, ALMM, asset encumbrance, and LCR. And there are 2 specific new reporting modules, that's GSIIs for identification of globally systemic important institutions, and also FRTB with respect to specific reporting requirements for market risk. We will now be delving into more details on each and every reporting module. We will start with significant changes to existing reporting modules, and the first one, and most probably one of the most complex reporting modules, is the own funds. I list here the articles of the reporting regulation which are associated with this reporting module, with the own funds. So there's articles 5 and 6, which outline reporting requirements on an individual basis on a quarterly and semi-annual reporting, respectively. Then there's Article 7, which outlines reporting at the consolidated level, which essentially includes the requirements in Articles 5 and 6 with some additional data requirements as well. There's a new article in the reporting regulation, Article 8, which essentially outlines additional reporting requirements on both individual and consolidated levels. And at the end, there's Article 13, 13, which outlines requirements on IP losses, in short, which are immovable property losses. We will start with respect to the own funds module with a summary of the reporting templates. As you can see, and I'm sure you're well aware, the own funds module can be split into some sections. There's capital adequacy, credit risk, IP losses, and so on. The new areas, the new data requirements are included in both. In the credit risk area, there are 6 new templates which outline new requirements on the IRB approach. There's an entirely new section on counterparty credit risk, which is essentially a new risk area which has been outlined by the regulatory package, and there are 11 data templates in total on this risk area. Then there is also another new section on NPE loss coverage, which essentially outlines the calculation of deductions for non-performing exposures and also minimum coverage requirements. In total, for this specific section, there are 3 data templates, which are new. We will start now also outlining some more details on the new data requirements that we have already discussed. So the first one is with respect to IRB approach, and even though these areas are not applicable to a lot of the local institutions, it is still worth noting the new data requirements. Essentially, there are a number of templates that are coming about and that are new with the reporting regulation. These templates outline the reporting of exposures for which the risk-weighted exposure amounts are calculated, of course, in accordance with the IRB approach. And essentially, in terms of requirements, the institution is required to submit these templates depending on the specific disclosure requirements also outlined in CRR2. A second new data requirement is with respect to the counterparty credit risk. This is an area essentially which has been enhanced in CRR2 with the objective to create a more risk-based approach for derivative exposures. There are quite a number of templates, 11 in total, I believe, on this specific area. The first part, which is outlined also in the table in the slide, outline the reporting of information on exposures that are subject, of course, to CCR, and the institutions are required to submit these templates with a quarterly frequency. Of course, not all the templates are required because it depends on the approach being used by that institution for the CCR. As you may already be aware, there are 4 different approaches outlined in the CRR. Apologies, all the acronyms are confusing. There are 4 different approaches outlined in CRR2 for CCR. That's right. And the institution is required to select one depending on the criteria of each and every approach. Another template, the C3406, is actually mentioned in 2 different articles of the reporting regulation. That's Article 5, Paragraph 7, and also Article 6, Paragraph 5. The reason for this is because there's a distinction for the reporting frequency of this template, depending on the approach being used by that institution for CCR. So essentially, if the institution is using the standardized approach or the internal model method for CCR, then the in-scope institutions are required to submit the template with a quarterly frequency. On the other hand, if the institution is using any other approach, so that's either simplified or the OEM, the institution is required to submit this template with a semi-annual frequency instead. The last 2 templates, okay. So there's C3407 and C3411. So essentially, these templates are also based on some approaches and the requirements based on disclosure requirements outlined in CRR2. For the first one, C3407, as background, it's basically the use of the advanced or foundation IRB approach to compute risk-weighted exposure amounts for CCR exposures, irrespective of the CCR approach used to determine the exposure values. And as outlined already, the requirements are based on other disclosure requirements also outlined in CRR. The second and last template for CCR is with respect to the use of an internal model method to compute risk-weighted exposure amounts, and the requirement is also related and dependent on specific disclosure requirements with respect to the CRR2 as well. Moving on, we will now explain some areas on the third area of new data requirements for the own funds module. There are 3 templates on the prudential backstop on non-performing exposures, which essentially outline the calculation of the minimum loss coverage requirements for non-performing exposures. Once again, of course, as outlined in CRR2. And the requirement, the institution needs to submit these templates with a quarterly frequency. We will now move on to outline some change data requirements, so areas which are already a requirement but which have some areas changed in terms of the requirements on the institutions. We will start first with the material losses on operational risk. Most of you should probably already be familiar with these specific templates, that's C1701 and 02. And what has changed here is the requirements and what are the requirements which are applicable according to 2 specific areas. The first one is on the approach used for calculation of own funds for operational risk. And the second one is with respect to the institution classification, whether it's NCI, regular or large. You may recall that we have already mentioned this concept in the beginning of this presentation. The second table in this slide outlines specifically the requirements. So in actual fact, you can see that depending on the operation risk approach and on the institution classification, the specific data requirements apply. In most cases, there are 3 out of 5 cases in reality which require institutions to report both templates in full. There is 1 case which requires institutions to report some specific data points, which are also outlined in the regulation. Either way, institutions are able and may report the information in both templates voluntarily. However, I doubt that this will be the case, that you would actually want to report these. Another change data requirement is also with respect to the immovable property losses. As you know, this is just the 1 template, that's C15, and what has changed here is the frequency from semi-annual to annual reporting. It's important to note that branches of institutions in another member state are also required to report this template with an annual frequency as well to the host member state. We will move on to the second reporting module, which has experienced also significant changes with CRR2. That's the leverage ratio reporting. Article 15 of the reporting regulation outlines the requirements for this reporting on both individual and consolidated levels. First, we will go through some binding requirements. You should probably know already that an institution is required to maintain a binding minimum ratio of 3% starting from June 2021. And with respect to the leverage ratio calculation in itself, an institution is required to calculate the leverage ratio as at the reporting reference date in line with CRR2. The reporting is with a quarterly frequency, and the leverage ratio shall be the value at the last calendar year of the 3rd month of the respective quarter. As a summary, there's a list of templates with respect to the leverage ratio reporting. There are 2 specific data templates which have been removed from the requirements, that's C41 and C42. And however, there's also an additional 2 new reporting requirements, which we will go through here. The 2 new data templates are C4801 and 02, and essentially is the reporting of information for the purpose of monitoring the volatility of the leverage ratio. However, these 2 templates are only required to be reported by institutions that are classified as large institutions according to CRR2, and the frequency of these templates is also quarterly. There are also some new data points within template C47 specifically, that's the summary of the leverage ratio, outlining also the actual ratio, and the additional data points are actually on Pillar 1 and Pillar 2 leverage ratio requirements, including SREP, P2R, and P2G requirements. You may recall that the SREP, P2R, and P2G requirements are communicated to the institution by the competent authority, it being the MFSA or the ECB as applicable, of course. We will move on to the third reporting module, which has significantly changed as well. That's the net stable funding ratio, NSFR in short. Article 17 of the reporting regulation outlines the requirements on both individual and consolidated basis. Once again, we will start with some binding requirements in that an institution is required to maintain a binding minimum NSFR of 100%. And with respect to the net stable funding ratio calculation, an institution is required to report information about required and available stable funding. We call these ASF and RSF in short, of course, other acronyms to remember, for the purpose of calculating and reporting the net stable funding ratio. And reporting for this module is also with a quarterly frequency. As a summary, all the templates that apply for this reporting module are new because of the new, of course, ASF and RSF requirements. The old, so-called old data templates C60 and 61 are both removed. And we will now delve a little bit in more detail on the requirements of these new templates. So you can see here the table outlines specifically all the requirements. I would like to start here to explain that even though there are 5 reporting templates in total, at any one point, an institution is only required to submit 3 data templates, depending on the approach being used by the institution. So in order to best explain this is to start with the second part of the table, that's the requirements being outlined by Article 17, paragraph A, with respect to templates C82 and 83. So these 2 templates are the reporting of RSF and ASF using the simplified methodology for NSFR. And an institution which is classified as small and non-complex that chooses to calculate an NSFR using the simplified methodology is required to submit these templates with a quarterly frequency. To note, and this is a very important point, that the use of the simplified approach for NSFR is subject to prior permission of the competent authority. I'm outlining specifically this point because we have already questions from some of the institutions in that if an institution does not have in hand the permission from the authority to use the simplified approach, then the default standardized approach for NSFR calculation needs to be used until if and when such permission is issued. Which takes me to the first area of this table, which is with respect to template C80 and C81, which are the reporting of RSF and ASF using the standard methodology instead of NSFR. And basically, as a requirement, institutions not falling under ITS Article 17, paragraph A, which are essentially the requirements for the simplified approach, that institution is required to submit these templates with a quarterly frequency. At the end, and one last template, C84, that's the summary NSFR, which is essentially the reporting of the ratio and the summary of the RSF and ASF as well. And regardless of the approach being used and regardless of the templates being reported, the institution is required always to submit this template to the authority. The fourth and last reporting module, which has experienced quite significant changes with ITS version 3.0, is FINREP. So I outline here 2 different regulations which outline the requirements for FINREP. There's essentially the reporting regulation, which we have been mentioning all along during this presentation. Then there's also the ECB regulation on reporting of supervisory information, financial information. As a starting point, we will go through, as always, through a summary of the reporting templates. You are, of course, already aware that the FINREP module, it being quite burdensome and includes quite a number of data templates, is split into 4 different parts 1 to 4, which are, as you can see here, split according to the frequency, and also part 2 specifically the frequency and templates associated with a specific threshold. To note that with ITS version 3.0, there are no new reporting templates and no removed reporting templates from FINREP. However, there are changes within existing reporting requirements, and we will be going through the 3 specific changes. So there are some new data requirements. The first one is on POCI assets, that's purchased and originated credit impaired assets. Those of you who are accountants, of course, can teach me on this because I'm not an accountant. However, essentially, POCI assets are any financial asset which is credit impaired at initial recognition in line with IFRS 9. And essentially, FINREP has been tailored, and it now accommodates new columns and rows in order to have the POCI assets reported separately. I outline here in this table also some examples of these inclusions. Some change data requirements within the FINREP module. The first one is this one specific line item, that's cash contributions to resolution funds and deposit guarantee schemes. Essentially, it was worth including this point in this presentation because we also last year got quite a bit of questions from some institutions. So essentially, this line item was included last year in template F2, which is the statement of profit and loss, but was not included then in F2003, which was the geographical breakdown of that P&L statement. With version 2.0, this line item is also included now in F2003 with the aim and objective, of course, to ensure consistent reporting in both templates. One last change within the FINREP module is the identification in the group structure. This relates specifically to templates 4001 and 4002, whereby, of course, and as outlined earlier in this presentation, the regulation in its entirety is promoting the use of the legal entity identifier for the identification of the counterparty. And essentially, these 2 templates have been tailored and to accommodate the reporting of the code, that's the LEI specifically. So essentially, for the group structure and specific columns with named code specifically, the requirement is for institutions and insurance undertakings. An institution is required to report this information using the LEI, and for other entities, an institution is required to report this information using the LEI as well, and if not available, a national code. We will now move on to other changes to existing reporting modules, which are considered less significant and so-called minor. I will have a sip of water first. Okay. So the first one is the large exposures reporting, for which the requirements are outlined in Article 4 of the reporting regulation. As a summary, so there are the majority of the templates have remained the same. There are 2 templates, however, which have been removed. That's C30 and C31. So I guess that's good news. And also there's the reporting of information on the 10 largest exposures to unregulated financial entities also has been removed. There are some new reporting requirements as well. The first one is the reporting of information on exposures of value greater than or equal to 300 million euro, but which are less than 10% of Tier 1 capital. The point here is being that the idea, at least, is for the institution to capture as well exposures which are considered significant in value, even though these exposures do not fall within the large exposures definition as such. The second new reporting requirement within the LE reporting is the reporting of information on the 10 largest exposures to shadow banking entities that carry out banking activities outside the regulated framework. Both these new data requirements apply on a consolidated basis only. The second module, which has experienced minor changes, is the ALMM, in short, for which Article 18 provides the requirements and outlines essentially all that is required on individual and consolidated basis. You may notice that for this reporting module, there's essentially quite a number of annexes associated to it. As a summary, once again, the templates, the number of templates and the requirements have not changed. So, and the frequency also stays with a monthly, at a monthly frequency. However, what has changed is the change in criteria for derogation from that frequency, from monthly reporting. So essentially, the EBA has decided to make use of the small and non-complex classification here, in that an institution that meets all the conditions set out in CRR2 Article 4.145, and that is essentially the paragraph outlining the criteria for small and non-complex, may report this module with a quarterly frequency. Some institutions may already recall that we as an FSA have already contacted the institutions to ask whether you will be reporting this specific module with a monthly or quarterly frequency. The third reporting module, which has experienced some minor changes, is the asset encumbrance module, for which Article 19 provides the requirements at both individual and consolidated levels. You may recall, of course, that this module is also split into 5 different parts, that's parts A to E, and the templates have not changed with ITS version 3.0. What has changed, once again, are the criteria for not reporting parts B, C, and E. So essentially, an institution is not required to report parts B, C, and D if both, and it's important that both of the following conditions need to be met. The first one is that the institution is not classified as large, and the second one is that the asset encumbrance level is less than 15%. The calculation and the method on how to calculate essentially the asset encumbrance ratio is also provided in the relevant documentation. We will now move on to outline new details on the new reporting modules. We will start first with the identification of globally systemic important institutions. There's a new article, of course, to outline the requirements for this module, and that's Article 20, which outlines the requirements at the consolidated level for the purpose of identifying GSIIs and also assigning GSII buffer rates. There's only the one template for this reporting module, that's G01, with a quarterly frequency, and essentially it provides for the reporting of supplementary information for the purposes of identifying GSIIs and also assigning buffer rates. As a requirement, EU parent institutions, EU parent financial holding companies, and EU parent mixed financial holding companies are required to report this module, this one template, at the consolidated level with a quarterly frequency, if, however, it satisfies the following two conditions. The first one is that the total exposure measure of the group is greater or equal to 125,000 million. And the second one is that at the EU parent, any of its subsidiaries or any branch is located in a participating member state. What is different as well with this specific reporting module are the remittance dates. So essentially, the reference dates are the same. That's March, June, September, December. That has not changed. However, there is a bit more leeway for the institutions, for the in-scope institutions that are required to submit this reporting module, in that the remittance dates are outlined also in the regulation. This template also has different entry and exit criteria, which are outlined in Article 20, paragraph 4, and they are specific for this reporting module for this template. So the entry and exit criteria of Article 4 do not apply in this case. The second and last new reporting module is the specific reporting requirements for market risk. So this is quite a different scenario here because the requirements are not outlined within the reporting regulation that we've been talking about in this presentation. However, there's another regulation which outlines the requirements in this case, and we will be going through some points on that regulation. So as background, there's the implementing technical standards for the application with regards to specific reporting requirements for market risk, and that's regulation 2021/453 specifically. This FRTB regulation, we can call it like that, outlines reporting requirements in accordance with specific CRR2 articles as well. The application date is different than the reporting regulation, and that's 5th October 2021, which makes the first reference date 30th September 2021 instead of June. So there's a little bit more leeway for the implementation by the institutions. To note that the reference and remittance dates are not different than the majority of the reporting modules for the reporting regulation, so the same can be applied for this reporting module. To delve a little bit into the details of this, there's two specific templates, that's the C90 and C91, and both are required with a quarterly frequency. We will start with the requirements on C90, and that's the trading book and market risk thresholds. And essentially, this is the reporting of information on the thresholds outlined in CRR2. To know, there are two thresholds which are very similar, but they are different in reality. So the first one is the threshold outlined in Article 94, paragraph 1. That's the derogation for small trading book business. And the second one is outlined in Article 325A, paragraph 1, which is the exemptions from specific reporting requirements for market risk. As a requirement, institutions are required to report this information with a quarterly frequency. To note, however, that quarterly reporting includes data as at the end of each month within that respective quarter. The second and last template for this module is C91, that's the own funds requirement, and this is essentially the reporting of the results or summary, if you will, of the information on the calculation of own funds requirements for market risk when using the ASA approach specifically. Once again, the acronyms got me there. So in terms of requirements in line with CRR2, Article 430B1, paragraph 1, states that an institution that does not, this is important, that does not meet both the conditions set out here is required to report this template, that's C91. So the first condition is that the size of the on and off balance sheet trading book business is firstly less than or equal to 5% of total assets, and secondly, less than or equal to 50 million euro. The second condition is that the size of the on and off balance sheet business subject to market risk on the basis of monthly assessment using end-month data is the first one, less than or equal to 10% of total assets, and the second one is less than or equal to 500 million euro. Of course, this may all look very complex, but it is very important that institutions and very essential in reality to look at the articles and understand the requirements and the applicability for their own institution. Okay, so we are nearing towards the end of the presentation. We will outline some notes which we deem are useful to the industry in general. The first note is that the MFSA does not have the power to postpone and or grant any extension to remittance dates. So we cannot in reality provide or grant any extensions to deadlines of the reporting module. In actual fact, the deadlines are outlined specifically in the reporting regulations, and those regulations do not give us as national competent authority the power to grant any extensions. A second point which we would like to outline is that the reporting framework is drafted and published by the EBA. So whilst the MFSA can offer its support to institutions when this is needed and this is requested, it cannot provide interpretations to legal and or other text that has been published by EU authorities. A third point that we would like to outline here is that institutions are required, it's an actual requirement, to comply with the requirements laid down in the regulation, including the data quality rules as published by the EBA. I would like to enhance a bit on this point in that you may be aware, and we've mentioned in the beginning of this presentation, that the EBA publishes a list of validation rules, which the institution is required to abide by, essentially, in its numbers. You should also be aware that this list includes both XBRL and non-XBRL validation rules. So essentially, if any of those rules, be it either XBRL or non-XBRL, if any of those rules is not adhered to, that's essentially a breach of the regulation, because the data quality rules are part and parcel of the entire regulation. Of course, the importance for the authority to receive good quality data is because our supervisory work, MFSA supervisory work, relies heavily on that data. So it is essential and imperative for institutions to implement appropriate processes internally to ensure good quality data is submitted to the MFSA. A fourth point, which also is related to the point that I just made, is that institutions should always report data in line with all relevant and applicable legislation and documentation, such as the template instructions. The template instructions, as I've already mentioned in the very beginning, are part and parcel of the regulation. So it is important that all the provisions in the instructions are adhered to. The instructions are there to be used and to be exploited. So it is important that these are used in the compilation of the data by the institutions. One last point, in that before reaching out to us as the authority with some reporting query, institutions should always consult the single rulebook EBA Q&A tool. So essentially, at our end, we have no magic tools in reality. When we receive a reporting question from one of the institutions or otherwise, we consulted the same documentation that the institutions have already access to. So it would help us a real lot, even to reply, to provide replies in a timely manner, that reporting query is made to us with all the relevant background in place. I also provide here some quick links, which are very useful. I believe this presentation will also be shared with the entire participants. Please do post questions in the teams in order to thresh out any queries that you might have from this presentation or any other work that is related to reporting. I now thank you for your attention. This is the end of my presentation, and I pass the floor to my colleague Joanne. Thank you very much.
Thank you, Roberta, for your detailed presentation. Now we'll be taking a short break, which is a little bit longer than we have expected, due that we are forward of the time, and we'll be back in session at 11:30. We'll do our best to address any questions you may have in relation to the presentation just delivered during the Q&A session scheduled rightly after we are back from the coffee break. Thank you and enjoy your break. Welcome back to the second part of today's webinar, which is dedicated to the Q&A session. We are pleased to answer all the questions we're pleased to receive during the Q&A session. Starting by the first question we have received. Can you please clarify the applicability of the validation rules packages as published by the EBA? Do the activations and reactivations in the small validation rule package apply retrospectively? To you, Roberta.
Thank you, Joanne. Okay, so there are two different packages that are being published by the EBA. For the small validation rule package, there are reactivations, deactivations, and severity status changes. For applicability, the small validation rule package applies upon the publication date of that package. This means that as from that day onwards, the institutions are required to abide by the new deactivations and/or reactivations of that package. This means that any submission or resubmission for past reference dates being done after that specific date needs to be in line with the new small validation rule package. It, however, does not mean that the institution is required to resubmit previous reference dates data for the simple reason to abide by these new rules.
The second question. We noticed that the LH portal project for submitting supervisory reporting modules has changed from CRD4 reporting to ITS on supervisory reporting. Does this mean that reports for CRR2 ITS version 3.0 will be submitted through this project, even though a new reporting regulation now applies? To you, Roberta.
Thank you. That's a very good question, and I see the confusion. So from a business perspective, you are right, because the new reporting regulation actually repeals the so-called old regulation. However, from a technical perspective, the EBA has set up and updated the same technical documentation as with the old regulation. So it's from a technical perspective, it is viewed more as an update rather than as new, which abolishes the old, so to speak. From an MFSA perspective, in LH portal, we have changed the project name from CRD4 to ITS on supervisory reporting. Is just a name change, so there are no essential changes apart, of course, from the new requirements coming about with CRR2. So essentially, institutions are required to use the ITS on supervisory reporting to submit reports for June 2021 reference date going forward, and also to submit reports for previous reference dates before June 2021 as well.
The third question. With respect to the new NCCI and large classifications in CRR2 and the remaining regular classification, are there set procedures on how an institution may change from one classification to another? Will this occur periodically? To you, Roberta.
Thank you, Joanne. This is a very good question, in fact, because we as MFSA are still delving into this as well. So the same question that you posed is also our question in reality. In mid-2020, so I think around August last year, the MFSA has sent a letter to all the institutions with the SNCI status, that is, whether the institution can be considered as small and non-complex or not. With respect to periodicity of the assessment, we are still awaiting from guidance internally as well as from EU authorities, that's the EBA and the ECB. So as soon as we have something in hand, we will inform the industry accordingly. Thank you.
The fourth question. The reporting requirements have increased significantly over the past few years, leading to an increase in costs needed by institutions to comply with these. Are there plans to reduce, in any way, the reporting burden on institutions, maybe through better proportionality principles? To you, Roberta.
Thank you. So yes, there are plans. So let's take a step back first. The increase in reporting requirements was actually a needed framework in reality because of the added supervisory tasks and responsibilities on the MFSA. So the added areas were actually a requirement even for us. However, there are initiatives by the EBA to reduce the reporting burden based also on proportionality principles. In actual fact, there was one exercise, the cost of compliance, which was initiated and was actually EBA was mandated by CRR2 provisions to study the cost of compliance of various institutions. And I can say that actually we had quite good feedback from local institutions in the participation of the questionnaires related to this compliance study. There's the report for this cost of compliance study has been published by the EBA as well. As a result from that cost of compliance report, the EU Commission will now take the recommendations and the results and the summary of that study to take into consideration essentially what reporting requirements can be reduced and for which institutions. There are also, I believe, 2 different consultation papers currently receiving comments from the industry and from stakeholders. These are published by the EBA, and both are proposing some reductions in reporting burdens, also taking into consideration the small and non-complex classification. So yes, there are initiatives, and the NCAs are actually consulted along the way before such consultation papers are published. Thank you.
The 5th question. Given that remuneration benchmarking reporting is relatively new, could you please clarify the submission process again, particularly in regard to cases where validation rules are not adhered to you, Roberta?
Thank you, Joanne. Okay, so yes, in reality, for remuneration benchmarking and when validation rules are failing and there's a justification for that by the institution, it applies the same throughout. It's not just for remuneration. So in reality, the institution is required, is essentially asked to submit to us through the banking data mailbox. I believe most of you are familiar with this, to submit to us the list of validation rules that the institution plans to fail, essentially, and the reason, the justification behind it. To note, of course, then after we as MFSA assess the situation, and also we view discussions that are ongoing with EBA, because there are instances where specific validation rules are not just debated by local institutions but also by other foreign institutions and also foreign NCAs. At that point, we reply to the institution outlining whether the justification has been approved or whether the justification is not enough to essentially justify the failing validation rules. It is very important, however, that the query, the email sent to the banking data mailbox is sent to us before the actual submission is made through the LH portal. The reason for this is because through LH portal, we as MFSA are able we can essentially disable some specific validation rules for specific institutions. In doing so, of course, then that institution can submit to us error-free, so to speak. At that point, then normally we liaise with the institution after that as well to provide updates when these are relevant on those specific validation rules, which are sometimes also handled through the EBA Q&A tool. Thank you.
The last question for today. How does the new ITS affect completeness checks? To you, Roberta.
Thank you, Joanne. So essentially, the completeness checks remain. We as MFSA publish a guidelines document in order to help the industry in avoiding these completeness errors, completeness issues. However, it is very important that the institutions still abide by the actual regulation. The document that we publish is merely a guideline document for the institutions. With the new data requirements and the added requirements in relation to reporting, there are of course new completeness checks, and once again the institution is required to abide by all these checks. Thank you very much.
Thank you, Roberta, for answering all the questions we're pleased to receive. This brings us to the end of today's webinar. We urge you that if you have any more questions, please do send us to them so we are pleased to answer to you. I would like to once again thanks to all the speakers and the attendees who have participated in today's webinar. Finally, I would like to thank all the teams and people who have been involved in order to make events like this happen. Once again, thanks to you all. and wishing you have a great day and important to stay safe. Thank you.